Hello and welcome to Strategy 101. Before we begin, I will say that if you have not watched my video about the basics of patterns and how to identify them, I would ask that you go watch that first, as it will greatly help your understanding of this video. So what we'll be going over today is the strategy that I use for trading. Many of you have requested it, and so here we are. My strategy uses a combination of patterns and three very specific moving averages. These moving averages, you can put them in your chart. They are simple moving averages based on close. As you can see, simple moving averages. The first one, the one that is blue, has a period of 50. The second one, which is orange, has a period of 100. And the third one, which is pink, has a value period of 200. So get those set up on your chart, and we will continue. This strategy is best used on higher time frames. The shortest time frame that I'll ever use for trading is M30. Anything shorter than that and it becomes more difficult to view the patterns as a whole. And you want to be able to see the bigger picture, as it will help you more accurately predict what's going to happen. So we'll begin at M30 and work our way up. This is Bitcoin versus the US dollar. And right off the bat here, if you've watched the pattern video, you should be able to see this head and shoulders right here. I'll go ahead and draw a line there for you. And like magic, there it is. Alright, so you have your shoulder on one side, the head, and the shoulder on the other side. As we learned in the pattern video, you would measure the height to the neckline. By doing that, it gives you the depth of the head, which here it's 36,869, to a height of 40,670. So we plug those numbers into our calculator. 40,670 minus approximately 36,855. And that gives us a price difference of 3,815. So what we would then do is, from where it broke down into the neckline, we would subtract 3,815. So our neckline right here breaks at 37678 minus 3,815. Gives us a target price of 33,863. I've gone ahead and placed a line at that price, 33,863. And as you can see, perfect take profit point. So using that pattern right there, we're able to predict an almost $4,000 drop in Bitcoin and the perfect take profit point. Now, how do my moving averages play into this? So moving averages, the very specific set that I have, the 50, the 100, and the 200, they are dynamic, moving support and resistances. Bots use it in their algorithm trading, and as do many big institutions. So we're going to zoom in a little bit and take a look at how the candles interact with these moving averages. I find that it helps me visualize it a little bit better if you think about them as gravity. The higher the number, the pink for 200, the stronger the gravity will be. The candles will want to return to those lines. And as you can see, they like to do that. We're rising up here, falls back down to meet that gravity. But in bullish momentum, runs away, comes back to meet it. it did not hold here, so it gets pulled to the next strongest gravity, and then the next strongest gravity. Dropped right past that because it didn't hold on the M30, but then returned to those moving averages. They are dynamic moving support and resistance zones, and you can see this when it gets caught in between them. Take a look back here at our head and shoulders pattern that we calculated out earlier. You have the SMA 100, treats it as support, goes up to make the head, comes down, gets caught by the gravity of the SMA 100, goes back up, but then is pushed down by the SMA 50. Because this was its last stopping point around the SMA 100, it came back down through, so it's going to fall to the next one because it already tested that support and it held that time, but it came down harder, so it's going to test the next one. Then it found its support at the SMA 200. Look at that right there. No more asking the question, oh, when is it going to stop dropping? This is how you can find out. Found its support here, went back up. Here you can see it trapped between the SMA 100 and the SMA 50. It'll just bounce back and forth between them. And if you look closely at it, we'll mark some lines here. So we draw our lines, and you see right there, it's a triangle. Kind of like the big triangle that we're dealing with right now on BTC. But you have a triangle here, and you can see not only does it follow your trend lines, but it also follows the moving averages. Now let's take a look at higher time frames. My personal favorite time frame, and you'll see me use this a lot for intraday trading and just general chart analysis, is going to be the hourly chart, H1. And you see, even in H1, if you remember on M30, this support right here was the SMA 200. Take a look at the H1. Still has support there, still on one of my SMAs, but it's the SMA 50. And then for the other side, it held on the SMA 200 on the M30 chart. Here it's holding on the SMA 100. So all of these moving averages, while they may have different weights depending on the time frame, your chart's still going to respect them. It's still going to, hit resistance here at SMA 50 and drop. Or, we had a cross, so now it's going to pull back. Let's talk about crosses, because I know you guys have heard me mention those. So a cross is when one SMA moves over top of another one. A golden cross is when the SMA 100 crosses over the SMA 200. Now what do these crosses mean? These crosses mean a shift in the overall trend. It's generally indicative of a reversal. Generally. There are always exceptions to this rule, which is why you combine it with pattern trading. You see here we had a golden cross. That is generally indicative of the movement will shift upwards. But when combined with our pattern trading, we saw the head and shoulders and knew not to fall for that trap because it was going to go down. You can use just patterns, you can use just moving averages, but both of them alone will not be as strong as if you combine them and use them both together. Alright, so for now we're switching over to the gold chart. Gold is actually the commodity that I developed this strategy on initially when I first started trading it about 8 years ago. I found it to be pretty reliable, very easily predictable, and full of fishhook patterns, which is great for making a lot of money. So, taking a look at this, we can see on gold that we had a golden cross right here on the H1, where the SMA 100 crossed over the SMA 200. As you can see from there, it was never that low again. That's what I mean when generally a golden cross is indicative of upward movement. And coming back here, you can see what's known as the death cross, where the SMA 100, orange, falls below the SMA 200, pink. That is indicative of strong downward movement, which you then have. To figure out where the strong downward movement ends, we then look at our patterns instead of just relying on the SMAs. So let's zoom out a little bit. Where it found its bottom here, it created a double bottom pattern. Double bottom patterns are indicative of reversal. So when we saw that bounce there, and we had a couple of good strong up candles, we knew that that was now its bottom. So by combining the SMAs with the patterns, you have a trading strategy that works really well in both bear and bull markets. I love viewing gold on the daily chart. It gives a great big picture. Patterns are very clear and apparent. I'll mark a couple of them here for you right now. Just as an example, we have 1, 2 falling wedges, and we have a bull flag right here. But on the daily chart, it's very easy to see patterns. It's easy to see the bigger picture, and you can find your levels a lot easier. You've got your bouncing off the SMAs here, 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 trapped in between two SMAs here, entered a consolidation pattern for, what was that, like a week or more? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 2 weeks, actually. It was trapped between these two moving averages. The key to using this is patience. You're playing on higher time frames. You're not doing your M1, M5, M15 in and out, every couple of seconds. You're not always trying to be in a trade. You're waiting for it to give you the right setup. When it's running, you wait. Wait for a pullback. When you get your nice bounce off one of the moving averages, that's when you hop in. Right here. With practice, it'll become more second nature to you. Like you see, you got your run here, hits resistance, blew right through this one, so it got caught on the next one because the SMA 100 is stronger than the SMA 50. Then it was treating the SMA 50 as support until it fell through, at which point it got caught on the next one, fell through, and then caught on the final one, which held beautifully. Overall, this is just a synopsis of the trading strategy. there are certain rules that I have for myself when I use it, such as I don't trade during low volume times, i.e., I like to avoid the weekends. I like to avoid between 5 p.m. or 4 p.m. Eastern Time and 7 p.m. Eastern Time, because that's when the US market's going to sleep, Asia market's starting to wake up. They tend to be prone to higher bouts of volatility. I just like to personally avoid that. I'm not looking for volatility. I'm looking for nice, beautiful, predictable setups. And sometimes you gotta wait through periods of consolidation to get those setups. But, would you rather work 10 jobs to make $100, or would you rather work one job to make $100? So it's quality, not quantity with this kind of thing. And since it is on a larger time scale, you could be in a trade, for a couple hours, but, you'll catch a much larger movement than if you're just trying to play like M1 or M5. So, I think we're going to go ahead and wrap it up here. I'll probably make some follow-up videos in the future, maybe one that goes a little more in depth into patterns, but in short, this video should give you the general rundown on how I do my trades, just based off of the patterns and the moving averages. Use the moving averages to find my dynamic support and resistance, and I use the patterns to predict what it will do, and then to predict exactly the pricing, how far it will fall, and then when it's done hitting that point, like how we calculated here, that it would come down to about this level based off the head and shoulders, as it finds its support, nice little rounded bottom right there, I know that I can expect it to then return to these SMAs. So when I see a pattern of reversal, such as a rounded bottom, I know I can hop on in and then take profit as it gets closer to the SMA. So it's all of these little things that work together to make the overall picture. As always, if you have any questions, you know where to find me.